Hello friends, how are you doing? Today we will be starting a new chapter for CFA Level 1 curriculum, which is called the Fixed Income Securities. So we will learn the different aspects of fixed income securities and do different sets of applications or problem sets on them. Let's begin. So we will understand the basic concepts behind fixed income securities, what they are and where they are applied and how they are issued. And then we will go into valuing them and what are the parameters for their valuation. We'll understand that. And then we will also go into what are the markets in which these fixed income statements are available or fixed income securities are available. And all these aspects we'll go through one by one. So before we start, first thing we do is we try to understand what are fixed income securities. Fixed income securities are a promise to pay a periodic or a one-time payment in the future after accepting a principal amount in the present. So I'll repeat it once again. Fixed income securities are a promise to pay a periodic or one-time payment in the future after accepting a principal payment in the present. So how this works? Let's say at time 0, you bought a fixed income security with rupees 100 or $100. Now this has a promise to pay you 5 rupees or $5 every period, say every year for the next 5 years, and at the end of it, it will also pay you back the principal amount. So this is going to be, the last payment is going to be principal plus the promised periodic payment. It can be set up in a different way where they will take 100 this year and for the next 5 years they will pay you 25 rupees. It can be arranged in another way that they take 100 from you right now and they do not make any payments here and they just pay 135 at the end of 5 years. This can also be a format. So these are all fixed income securities, which is basically a promise to pay. They have promised to pay that they will pay paying this amount over a certain period of time or after a certain period of time, or they will pay this amount rupees 25 over the next 5 years, that is over a certain period of time, or they will be paying amount of $5 per period and at the end they will return the principal also. So these are different formats in which a fixed income security can be designed. So we will now take a few more examples of this. Examples of fixed income securities. Now a few synonyms of fixed income, what we are calling fixed income securities, is we all have heard about them, I guess. They are bonds, debentures, and similar other terms. So basically these are debt instruments, debt or loan instruments. Now let us take a few examples of these bonds or these debentures or these fixed income securities. One example is a zero. Now what is a zero? We have already seen the example. A zero means right now they will be taking a certain payment X from you, and a few periods later, say 1, 2, 3, 4, 5 periods later, they will be paying you X plus something. This is what will happen. Let's say they take 90 rupees from you and at the end of 3 years they pay you 100. Like this is called a zero, that there are no periodic payments, zero periodic payments, and at the end they pay you certain amount. Fixed rate bond. What is a fixed rate bond? This also we have taken an example before. Let's say they will be taking from you 100 rupees right now or $100 right now, and every period they'll be paying you $10 for the next, say, 10 years. T is equal to 10. This they take at t is equal to 0. The first payment comes at, say, t is equal to 1, and this goes on till t is equal to 10. Now at the final we call it maturing amount, that is when the period of promise ends, they also return you the principal. So the total amount they pay you back is 110. Okay, so this you can call a fixed rate bond, because they are paying fixed amounts. Every period they'll be paying a fixed amount of, you can say, interest or a coupon, and at the end they pay the principal back. A floating rate bond. Let's say a bond promises you against your payment of rupees or $100 at t is equal to 0, it promises that it will pay a reference rate plus 5% every period. Now this reference rate can be many kinds. For example, a reference rate can be the rate at which banks lend each other, right? Banks lend each other. Let's define it a little more in a refined way. Banks lend each other overnight, that is for one 24-hour period. Now let's say at t is equal to 1, t is equal to 2, t is equal to 3, the rates are like this. The reference rate is, at t is equal to 1 it is 2%, at t is equal to 2 it is 3%, at t is equal to 3 it is 1%. So the bond will pay you at t is equal to 1, it will pay you 2 plus 5%, which is 7%. At t is equal to 2, it will pay you 8%, which is 3% plus 5%. At t is equal to 3, it will pay you 5 plus 1%, that is 6%. So this rate is varying, you can see. It's a varying coupon payment bond. So it's called a floating rate bond. So these are the main three examples that we wanted to look at: a zero, a fixed rate bond, and a floating rate bond. So friends, there are various features and parameters associated with a fixed income security or a bond. And a buyer of the bond needs to consider all those features to make sure that his or her requirements are fulfilled by those features or parameters. And those parameters can be secluded or separated and those parameters can be segregated into three main segments. The first set of features are issuer, maturity, coupon rate or interest, frequency, par value, and currency denomination. Issuer means the user or the buyer might be looking at whether it's a government entity or a private entity. Maturity means what is the time at which the promised payments end. It can be 5 years, it can be 10 years, it can be 20 years, 30 years, it can be even less than 1 year. Coupon rates or interest. How much on the principal is the buyer going to get? And how frequently? This is the frequency. So let's say the bond is promising 8% per year at a quarterly frequency. So in a simplistic way, we can deduce it in this way, that the bond will be paying 2% every 3 months. So 8% annually translates in a simple calculation to 2% quarterly. So this becomes the quarterly or the annually per annum. This becomes the frequency. Par value. Par value is nothing but the principal amount. That is the amount which the buyer is willing to pay to get the promised payments of the future. Currency denomination. So is it a foreign currency the bond is going to be invested in, or is it a domestic currency? And what is the currency in which the returns or the coupons or the interest will be paid? What is the currency in which the principal is going to be paid? These are also considerations. Now the second set of features are legal, regulatory, and tax situations. So,
what do we mean by this?
Let's say
there are two
companies.
One is
One
a
is a
fertilizer
fertilizer
company,
company,
and
and
one is a
a
wind
wind
energy
energy
company.
company.
Now,
Now,
on
on
this, the
this, the
government has
government has
stricter
stricter
rules
rules
because it
because
is
it is
producing
producing
chemicals
chemicals that
that
are
are controversial
controversial
in
in
terms
terms
of
of
whether they
whether
are
they are
actually in the
actually in the
long run
long run
going
going
to
to
benefit the
benefit the
farmer or
farmer or
benefit
benefit
the
the
consumer of
consumer
the
of the
food.
food.
So
So
there
there
are
are
various
various
regulations
regulations
every
every
day
day
which are
which are
changing and
changing and
tightening
tightening
up
up
the
the
production
production
system of
system
the
of the
fertilizers.
fertilizers.
There can
There
be
can be
tax
tax
issues
issues
also.
also.
On the
On
other
the other
hand,
hand,
there is
there is
this
this
green
green
energy
energy
company,
company,
renewable energy
energy
company.
company.
Government is
Government is
trying
trying
to
to
expand
expand
its
its
green
green
energy
energy
portfolio, and
and
therefore
therefore
giving
giving
various
various
perks to
perks to
companies which
companies
are
which are
producing wind
producing wind
energy.
energy.
The
The
reason
reason
being,
being
it
it
is
is
environmentally
environmentally
suitable,
suitable,
and the
and the
government is
government is
looking at a
looking at a
future
future
which is
which is
dominated
dominated
by
by
green
green
energy
energy
producers.
producers.
So this
So
can
this
be a
can be
way
a
we
way
can
we
look
can
at
look
the
at the
differences
differences
between
between
legal,
legal,
regulatory, and
regulatory,
tax
and tax
situation. We'll
situation.
take
We'll take
one more
one more
example.
example.
For
For
example,
example,
there is a
there is a
company
company
which
which
makes
makes
herbal
herbal
solutions
solutions
for
for
various
various
health
health
situations.
situations,
Herbal
herbal
health
health
solutions,
solutions,
or say
or say
organic
organic
herbal
herbal
health
health
solutions.
solutions.
And there
And
is
there is
another
another
company
company
which
which
produces
produces
cigarettes,
cigarettes,
or say
or
it
say it
produces
produces
liquor.
liquor.
Now,
Now,
between these
between
two
these two
companies,
companies,
the
the
tax
tax
rate
rate
of this
of this
company
company
might
might
be
be
far
far
lower
lower
than this
than
one.
this one.
Here,
Here
the
can the
tax can
tax
be
can
very
be very
high.
high.
Here, the
Here
tax
the
can
tax
be
can be
far
far
lower.
lower.
So these are
So
the
these are
two
the two
examples
examples just
to
to
emphasize
emphasize
what
what
can be
can be
the
the
legal,
legal,
regulatory, and
regulatory, and
tax
tax
situation
situation
impact
impact
on
on
different
different
industries,
industries,
different
different
companies in
companies in
different
different
situations.
situations.
Now, the
Now, the
third
third
feature
feature
that we have
that
to
we have
look
to
at
look at
is
is
contingency
contingency
provisions.
provisions.
Let's take
Let's
an
take an
example of
example
it.
of it.
Let's
Let's
say
say
a
a
company
company
ABC
ABC
has
has
given
given
out
out
thousand
thousand
million
million
dollar
dollar
worth
worth
of
of
bonds.
bonds.
Now it
Now
has
it
to
has to
repay it
repay
in
it in
5
5
years.
years.
Now in
Now in
5 years
5 years'
time,
time,
profits have
profits
gone
have gone
down,
down,
and
and
hardly the
hardly the
interest can
interest
be
can be
covered,
covered,
let alone
let alone
dividends and
dividends
all
and
that.
all that.
Okay.
Okay.
Now
Now
there
there
can be
can be
provisions
provisions
to
to
favor the
favor the
bondholders in
bondholders
this
in
kind
this
of a
kind of a
situation,
situation,
that
that
you have
you
to
have to
liquidate
liquidate
assets.
assets.
One of
One
such
of such
provisions
provisions
can
can
be
be
you have to
you have to
liquidate
liquidate
assets,
assets,
certain
certain
assets,
assets,
and
and
pay
pay
back
back
the
the
principal
principal
plus
plus
interest,
interest,
principal
principal
plus
plus
interest
interest
to
to
the
the
bond
bond
buyers,
buyers,
right, or the
right, or the
lenders.
lenders.
This is
This is
because
because
they,
they,
in the
in the
initial
initial
stages, they
stages, they
suspected that
suspected
when
that
this
when
kind
this
of a
kind of a
situation
situation
comes, that
comes, that
profits have
profits
gone
have
down
gone down
below
below a
a certain
certain
level
level
compared to the
interest
interest payments
payments
and
and
the
the
principal
principal
payments.
payments.
They
They
are at
are at
risk that
risk
the
that the
company
company
might
might
not be
not be
able to
able
pay
to
the
pay the
principal
principal
back,
back,
right?
right?
So
So
they
they
want
want
the
the
assets to be
assets to be
liquidated,
liquidated,
and a
and a
certain
certain or maybe a
certain
certain
amount
amount of the
to
asset
be
to be
liquidated,
liquidated,
and the
and the
principal to
principal
be
to be
paid back
paid back
along with
along
the
with the
remaining
remaining
interests.
interests.
So this
So
can
this
be one
can
of
be
the
one of the
contingency
contingency
provisions.
provisions.
Also, we
Also,
must
we must
remember
remember
that
that
bond
bond
debentures,
debentures,
these
these
are
are
basically
basically
debts,
debts,
right?
right?
Loan.
Loan.
And
And
their
their
claim
claim
is
is
higher.
higher.
Their
Their
claim is
claim is
higher
higher
than
than
the
the
stockholders.
stockholders.
Stockholders
Stockholders
means
means
the
the
owners of the
owners of the
equity
equity
of the
of the
company.
company.
But
But
on the
on
other
the other
hand,
hand,
they do
they
not
do not
have
have
ownership
ownership
rights.
rights.
They do
They do
not.
not. have ownership rights.
Ownership
Ownership
rights
rights
means
means
they
they
do
do
not
not
have
have
rights
rights
to
to
the
the
growth
growth
that
that
share
share
market
market
gives
gives
a
a
company.
company.
Maybe the
Maybe the
stocks of the
stocks of the
company are
company are
listed
listed
and the
and the
price
price
was
was
100 when
100
the
when the
bond was
bond was
released,
released,
and now
and
it
now it
is
is
like
like
500.
500.
That does
That
not
does not
impact
impact the
the income of the
income of the
bondholders.
bondholders.
Only the
Only the
equity
equity
holders
holders
benefit from
benefit from it,
it, right?
right?
On the
On
other
the other
hand,
hand,
management
management
decisions,
decisions,
they might
they
not
might
have a
not have
role
a role
unless the
unless the
company is in
company
a
is in
big
a big
soup
soup
in
in
terms of
terms of
profitability
profitability
and
and
debt
debt
payments.
payments.
They
They
might not
might
have
not
any
have
role
any role
whatsoever in the
whatsoever in the
management of the
management of the
company
company
or
or
deciding the
deciding the
strategy or
strategy or
policy of the
policy of the
company.
company. So this is one aspect we must remember carefully. I'll repeat once again. So the bond and the debt holders are basically the lenders, loan givers to the company. Their claim is higher than the stockholders. That means if a company is liquidated due to some reason, the lenders have to be paid back. First, the debt holders and the bond holders have to be, or the lenders have to be paid back. Then if something remains, the equity holders will get. Otherwise, equity holders will get nothing. So their claim is higher than the stockholders means just this. When some liquidation happens, or in a general term, first the interest has to be paid, the principal has to be paid in the promised way. Then if something remains, the equity holders get a chunk of that. Otherwise, they do not get a chunk of anything. On the second hand, the debt holders or the lenders do not have any ownership rights, which means if the stock grows from 100 to 500, the bond holder's income does not change. It remains what was promised at the beginning of the issuance of the bond or the purchase of the bond. It remains the same. Say the promise was it will pay 8%. So even if the profit is 500 or 100 from stocks, or the profit has increased from 100 to 1000 crores, it will not impact the bondholder's income. It will remain that initial promised percentage only. On the other hand, equity holders can take benefit of it through dividends, through stock value growth, etc. etc. Yes, when the company is in a big soup in terms of loan payments, in terms of capital situation, liquidity situation, then the lenders might have the right to come in and take over or take decisions on behalf of the management. Now what we'll do is we will look at all these features individually and try to go in a little bit more detail of each of these features. Okay. So first feature we look at is the issuer. So who can be an issuer? Issuer means one who releases a bond and makes the promise that certain periodic payments or certain one-time payments will be made at a certain given times, right? So who can do that? First is any sovereign government can do that. Let's say government of India can do it, government of USA can do it, etc. etc. Quasi-government entities. Quasi-government entities means which are related to the government but are not exactly the government. For example, post offices can release bonds. These are quasi-government entities. Non-sovereign governments. This can be city governments or state governments. For example, government of Minnesota, government of West Bengal, which is a state in India, they can release bonds. These are non-sovereign governments. Supranational entities. Supranational entities, example can be World Bank, which is a global entity, and this is also an entity which can issue bonds. IMF, International Monetary Fund, they can also issue bonds. Private entities means any private business enterprise which can be financial or non-financial, financial or non-financial. For example, Citibank can release bonds. SBI, Indian Bank, State Bank of India can have their own bonds issued. Non-financial, the Tata Group can issue their bonds. Apple can issue its bonds. Google can issue its bonds. Like that. Special purpose entity. Now what is that? Many times it happens that certain assets of a company, say the company has this much assets, and it selects a certain portion of it, it selects and separates it, like it becomes a separate entity altogether within a special purpose vehicle or an entity. So a special purpose vehicle or entity is basically a chunk of an asset which was belonging to a certain corporation or company, but now it does not belong to the company, it belongs to the special purpose entity. Why? Because it wants to create securitization out of it. Securitization. Now what is this securitization? Let me take an example. Let's say a company has a certain amount, or a financial company has a certain amount of loans. From that amount of loan, what it does is, loans is basically an asset for a financial company. So let's say it has $1 billion of loans as an asset in its books. From this, it takes out 100 million. This is this chunk that we are talking about. It takes out 100 million, puts it in a special purpose vehicle. Okay, and this 100 million worth of assets is divided into $10 units, securitized units, we can call them securitized units. Right? Now what is the purpose of this? Let's say these loan amounts was earning the company 8%. So what they do is, they say, they release this securitized unit to the public. They call it asset-backed security, asset-backed securities. Okay, so let's say these are home loans. So what they say is, you buy 100 of these, so you buy 100 of these with $1,000 and you get 6% from it. So what happens is, the public gets 6% from these loans. So this is what securitization means. You take out a portion of a corporation's assets, put it in a special purpose vehicle and divide it into small parts, and then distribute it or sell it to retail investors or maybe qualified institutional investor, depending on the size. It can be $10, it can be $10,000, depending on the size, and you commit to pay a certain amount of return on that asset. This is basically what securitization means. Friends, now we look at the second feature, which is maturity. Let's say a bond issuer has promised that upon paying the principal at t is equal to 0, the issuer will be paying back 8% for the next 5 terms, that is 5 years. For example, t is equal to 1, 2, 3, 4 and 5, and at t is equal to 5, that is the 5th year end, it will pay back the principal also, right? And in between, this 8% is going to be paid at the regular intervals. So the payment of the principal comes at t is equal to 5. The issuance happens at t is equal to 0. Therefore, the maturity of the bond is 5 years. Now let's say one of the bond buyers or many of the bond buyers sell the bond at t is equal to 2. Right? So here somebody buys at a certain price. Say they buy at 100 only. 2, 3, 4, 5. So they will also get the principal back if they hold it till maturity. They will get the principal back at year 5. Plus they will also get the interest of the year 5, and they'll get the interest here and here, right? So for them the maturity happens at a shorter time than the actual maturity from the issuance of the bond. This shorter maturity is termed as a tenor of a bond, right? Here in this case the tenor is 1, 2, 3, 3 years. Now in terms of maturity, if you have to divide the bonds, there are two kinds of bonds. One is money market securities. For them, the maturity is 1 year or less. Another one is capital market securities. Here, the maturity has to be more than 1 year. It can be 10 years, it can be 5 years, it can be 30 years. And there is one special category of bond which was at one time released, for example, by the sovereign government of UK, that is called a perpetual bond. As the name suggests, here the maturity is infinity. The coupon is going to be perpetual. Once released, once you have bought the bond, you will be perpetually getting the coupon or the interest. I'll repeat the definition of the terms maturity and tenor once again. The term maturity applies to the time of issuance till the time of maturity. Say the bond issuer issued it at time is equal to 0, or say he issued it at 2018 and the maturity happened at 2023. So the maturity is 5 years. Now after issuance in the markets, somebody sold it to some other buyer at t is equal to 2. For that buyer, the maturity is actually the same, 2023. Now that shorter maturity for the new buyer is not termed as maturity, it is termed as the tenor. So once the issuance has happened, from the issuance till maturity, the duration is called maturity. When somebody buys in between in some time, then for that buyer the term maturity is replaced by the term tenor. Now we proceed to the subsequent features, which are par value and coupon or interest alongside frequency. So let's look at what each of these mean. First, let us take par value. Let's say a bond has a maturity of 5 years, 0, 1, 2, 3, 4, 5. This is maturity, which means from issuance till the last payment. So at maturity, the bond promised that against a payment of $1,000, it will pay $80 every year, along with the principal at the final maturity. Right? So at final maturity, it pays back $80 plus the initial principal amount. Now this initial principal amount is nothing but the par value. Par value is nothing but the principal amount. It is called simply the principal or principal value. Now the issuance may happen at 1000, which means the issuance has happened at par. Now we will come back to the par value once again, but first let us understand a little bit about coupon and frequency. So if we take the same example of this bond with 5 years of maturity, 0, 1, 2, 3, 4, 5, initial is $1,000 principal payment and periodic payments of 80, 80, 80, 80 plus 1000, right? Now if it is mentioned that it will pay 8% coupon every period, then if you calculate 80 by 1000 is actually giving 8%, right? So this is the coupon rate. Coupon rate is the percentage of coupon on the principal amount. Percentage coupon rate coupon rate is the percentage of return or the periodic return on the principal. And this was mentioned at 8% of the principal, right? This principal is nothing but the par value. Now let's say in another situation at time is equal to 2, due to market related factors, the price of this bond at time is equal to 2 for the buyers is 1050 instead of the issuance price. So here we can say the bond is trading above par or at a premium. The bond is trading at a premium at t is equal to 2. In another situation, let's say the bond, instead of trading above $1,000, it is trading at $900. So here in this case we'll say the bond is trading at a discount to par. If whatever the principal amount is mentioned and whatever the coupon rate is mentioned on it, if the price of the bond goes ahead of it, goes past it, that is increases from it, we say the bond is trading at a premium to par. When it is trading at a lower price from it, then we say the bond is trading at a discount to par. Issuance generally happen at 100% of par, which means 100% of par means the issuer will say we will be paying 8% of par. That means our par value is, say, generally it is $1,000 and we will be paying $80 on it. Issuance is generally at par. Now, if instead such a thing happened that the issuer said our coupon is 10% of par and we will issue the bond at 125% of par. We will issue at 125% of par. So that means we'll be issuing at $1,250 and we'll be paying $100 interest on it. Right? A third case could have been our coupon, the issuer might say our coupon rate is 10% of par, but we will issue it at 80% of par. These two conditions generally do not happen, but I am just taking this example to make you understand what the term par means. The par means 100% of principal. So it is 80% of par means 80% of the principal, or 80% of 100% of principal. So this means we will issue each unit at $800 and each of these units will pay the buyer of this bond unit $100. So right now we got an idea of what a coupon or interest rate means, right? So let's say the bond is going to pay you 8% of par and the bond is going to be issued at 100% of par. So that means the unit price can be $1,000 and the coupon will be $80. This 8% is an annual rate. annual rate, right? Now let's look at what is frequency. In this example, if the frequency is annual, then every 12 months the buyer will get 8% or $80. Instead, if the frequency is semi-annual, then every 6 months the buyer will get 80 by 2 is equal to $40. A third case, let's say the frequency is quarterly. In that case, every 3 months the buyer of the bond will get 80 by 4 is equal to $20. 12 divided by 2 gives 6. So 2 periodic payments will be paid in this case. 12 divided by 4 is equal to 3. So 4 periodic payments will be paid in this case. The annualized rate is 8%, so the total payment over the year is 80, but it will be broken up into 4 or 2 periods. If it is broken up into 2 periods, each periodic payment becomes 40. If it is broken up into 4 periods, each periodic payment becomes 20. So this is the significance of the frequency. So frequency is the number of periods into which the coupon payment is distributed into. Number of periods into which an annualized coupon payment is distributed into. Now, in terms of coupon payment, bonds can again be divided into 3 separate segments. One is plain vanilla bond, one is a floating rate bond or a floating rate note, one is a zero coupon bond or a pure discount bond or simply a zero. Now let's see what is the difference between each of them. A plain vanilla bond, there are periodic payments. Yes. A floating rate bond, there are periodic payments, which means in both the cases, let's say if the maturity is 5 years, each of those 5 years there will be periodic payments. It can be annual, it can be semi-annual, it can be quarterly, it depends on whatever the condition is set during the issuance of the bond. In case of a zero, there is no periodic payment. So if the maturity of a zero coupon bond or a pure discount bond or a zero is 5 years, that means at time is equal to 0, it will take the principal, and at t is equal to 5, it will pay a lump sum amount. Say it will take 80 rupees at t is equal to 0, and at t is equal to 5, it will pay 100 rupees, or $80 at t is equal to 0, or it will pay back $100 at t is equal to 5. That's how it's going to be. Now coming to the coupon rates, in case of a plain vanilla bond, the coupon rate is fixed till maturity. So let's say if the maturity is 5 years, the initial unit price is $1,000, which is 100% of par, and the declared coupon rate is 6%, then it will pay $60 every period. That is 6% if it is annual, then it will pay $60 every year. Now it can be divided semi-annually or quarterly, right? No variation. In case of a floating rate bond or a floating rate note as they call it, let's say there is a reference rate being the rate, for example, at which banks lend each other. So here it is given in such a way, for example, say it will be reference rate plus 3%. So at time 1, 2, 3, 4, at 0 you buy it at $1,000, right? At time 1, let's say the reference rate is 1%, so you'll be getting 1 plus 3 is equal to 4%. At t is equal to 2, let's say the reference rate is 0%, you will get 0 plus 3 is equal to 3%. At t is equal to 3, let's say the reference rate is 2%, you will get 2 plus 3 is equal to 5%. Like this it will go on till maturity. Let's say the maturity is at 5th year, you got 7% and 4% in the final years, and also you got the initial principal back. So this is how a floating rate bond or a floating rate note works. Zero coupon bond. Zero coupon bond simply means there are no periodic payments. So let's say if the maturity is 3 years, you will pay say $80 per unit, and at the end of the third year you will get back say $100. This is the way a zero coupon bond or a pure discount bond, or simply called a zero, works. So this zero coupon bond is also called a zero or pure discount bond. Again we'll repeat. A plain vanilla bond, from initiation till maturity, the coupon rate is fixed, there is no variation, right? A floating rate bond, there is variation with respect to the reference rate. As the reference rate varies, it becomes from 1 to 0, from 0 to 2, from 2 to whatever it changes to 4, then again it changes from 4 to 1. So there is variation, and accordingly the rates also, the coupon payments also vary, which is not the case with a plain vanilla bond or a fixed coupon rate bond. In case of a zero coupon bond, we already know what is the payment we are going to get at maturity, and we already know what is the amount we have to pay at the time we are trying to buy it. So let's say at issuance, we already know that we have to pay 80, and we will, at the end of the third year or end of the maturity, we will get $100, for example. So we already have those informations. Let's say a dollar denominated bond is issued at t is equal to 0, and this bond has a maturity of 5 years. Now the initial principal payment is at dollars, and the interests received, let's say the coupon rate is 8%, so you receive $80 each time annualized, and 80 plus 1000, you receive it in dollars, right? $1080. So there is no variation of currency here. You get the coupons and the principal every time in dollars, right? So this is a single currency bond, which is a normal situation. Now let's say there is a dual currency bond issued, which is a Euro-US bond. Euro-USD bond. What is the difference between these two? Here, if all the features are same, let's say the maturity is 5 years, initial payment was in dollars. Here, the buyer has the option of receiving the coupon payments in one currency and the principal payment in another currency. Let's say it receives the coupon payments in euros. It gets the payments in euros. So whatever the let's say it gets the payments in euros. Here the payments are made in euros, and the last principal payment is made in dollars. These all are made in euros. Whatever the exchange rate is, based on that the payment is made, right? Now the same Euro USD bond is released by somebody else, and the issuer makes only one difference. The issuer says that you can redeem each of the payments in different currencies. Here what happened is you have to choose one currency for all the interest payments and one other currency for the principal payment. Either you choose euro for the principal payment and dollar for all the interest payments, or you choose dollar for all the interest payments and euro for the principal payment. Here what happens is you have a choice every time, euro or USD. Here also euro or USD. Third time also, fourth time also. Every payment you have a choice, right? Depending on the exchange rates, you can decide. This is a currency option bond. So the difference between a dual currency and a currency option bond is, in a currency option bond, you have an option to choose the currency each time. Here, you choose currency each time. Choice of currency for each individual payment. Here, choice is fixed for interest and principal. One currency for each. For either, right? In the case of single currency bond, there are no such choices, so there is no point of discussing it. So now we will look at two very important metrics, current yield and yield till maturity. How these are related to the bonds and brief idea about how they are calculated. So the current yield is coupon amount divided by the current price. So we can clearly understand, if the current price is more than par, current price, let's say we denote it by P, and coupon we denote it by C. If current price is at a premium, that is, it is more than par, the current yield will be less than the coupon rate, right? It's very simple. Let us decipher. Let's say the par value was 1000 and the coupon amount was 60, right? Now the price has become premium. It has become 1100. So 1100, 60 by 1100, this is obviously less than 60 by 1000. So the current yield is less than the coupon rate, right? Similarly, if the price is at a discount to par, that is, par is more than this current price, then current yield is more than the coupon rate, right? Simply, if instead of 1100 this was 800, this will be more than 60 by 1000, right? This is what is happening with the current yield. Now we will look at YTM, or yield to maturity. Let us try to understand what is yield to maturity, my friends. Let's say again a bond has a maturity of 5 years, right? Currently we are at t is equal to 3, right? This is the present. So right now the bond is, say, priced at 1200. The bond was issued at 1000, that is 100% of par. Now it is trading at 1200. Its coupon was $100 per period, right, per year, say. So it is $100, $100, $100, right? So at the end it gets $100 plus 1100, plus $1000, which equals to $1100. Now at t is equal to 3, if I have to buy this bond, I have to pay from my pocket 1200, right? So at t is equal to 3, which is, for me it is t is equal to 0. Against that, at t is equal to 1, I'll receive $100, and at t is equal to 2, I'll receive $1100. Now what is the yield to maturity for me? It is nothing but that rate which, when used to discount these two values, will give a present value of 1200 plus 1200. So plus 1200 has to be equal to 100 by 1 plus YTM plus 1100 by 1 plus YTM square, 1 plus YTM whole square. Whatever value this one takes to satisfy this equation is going to be called the yield to maturity, right? You can write it another way. Because I wrote it in terms of cash flows, you can simply write it another way. Minus 1200 plus 100 by 1 plus YTM plus 1100 by 1 plus YTM whole square should be equal to 0. So the outgoing and the incoming has to balance each other. This is nothing but this equation only modified and everything put into one side, right? I brought the 1200 at the same side. So guys, now we will learn what is a bond indenture. Basically, what the bond will do, what the coupon will be, what the principal amount will be, what is the maturity, and all these details. What are the obligations of the issuer, the rights of the bondholders, like what are the dues for them, the form and features of the bond. All these things and much more have to be documented somewhere. Some legal document has to be there, otherwise the authenticity of the document itself or the promise itself is in question. So this is maintained by something called a trust deed. This document is called a trust deed, and this same document has another name also, especially in US and Canada, which is called bond indenture, right? So apart from these three informations, a trust deed has these three information, that is the obligations of the issuer, the rights of the bondholder, the form and features of the bond. Apart from these three, this document, the trust deed or the bond indenture, has further information like what is the legal form or identity of the issuer. Is it a listed company? It is a non-listed company? Is it a limited company, or what kind of a format, corporate format is it? All these information are there. Source of interest and principal payments. So the repayments, when the bondholder is going to pay back, say 8% coupon for next 10 years or next 5 years, along with the principal payment along at the end of the tenure, where is the payment going to come from? That details is also there. How will the company earn the money, or what are the sources of those income? That is also there. Collateral details. So if somebody is giving you a bond, there can be collateralized assets behind it. For example, somebody is giving you selling you asset-backed securities. That person will have assets that is in the form of mortgages, right? Home loans, for example, that will be shared with you. Those details will be shared with you. Credit enhancement details. So these are basically certain structurings of the financial instruments to reduce credit risk. Reduce risk of the bondholder. Then there are covenant details. Now what are covenants? Covenants are basically certain criterion that oblige the issuer to act in a certain way under certain conditions, or prohibit the issuer to act in certain ways under certain conditions. For example, let's say the interest coverage has fallen below 2, right? In this condition, there can be a clause or a covenant that you cannot pay dividends. Dividends cannot be paid. This is an example of a prohibitory covenant. So we will look at each of these points in further details in the coming section. So friends, before we learn about these 5 points in details, we have to know one more aspect of the bonds, that is a trustee. Now who is a trustee? A trustee is basically an entity which holds the indenture, the bond indenture, and acts as the fiduciary. Fiduciary means one who ensures that the rights of the bondholders are intact and the issuer is abiding by the promises made by it. Some of the activities of the trustee can be invoicing the issuer for interest and principal payments, safeguarding the rights of the bondholders in terms of collaterals, covenants, and all these parts. They can also hold funds till payment is given to the bondholders. So these are some of the activities. In case of default by the issuer, the power of the bondholder, the power of the trustee can increase considerably. So legal form and identity of the issuer. Friends, we have already learned what can be the possible legal forms of different kinds of bond issuers. We have to just ask whether it's a government entity, whether it's a supranational entity, whether it's a non-sovereign government, whether it's a sovereign government, whether it's a corporate company. In case of a corporate, we have to see if it's a holding company or operating company or a subsidiary. For example, if the holding company which is holding stakes in various operating companies, its access to assets of those operating companies might be limited. In that case, the credit rating of this holding bond or the bond released by this holding company will be less. Subsidiary. Many times, rather than the mother company or the parent company, the subsidiaries' credit ratings can also be less. Then comes, we have to see whether it's a special purpose vehicle which is releasing the bond or the structured instrument. What are the assets? What is the quality of those assets? The main reason why a special purpose entity is created is bankruptcy remoteness, right? So this means if a financial entity creates a special purpose vehicle and sets apart some of its mortgages, then these mortgages are no longer part of this main financial company. They become part of the SPV and they are bankruptcy remote from the creating company. So when these are transformed and securitized into asset-backed securities, then the buyer of this asset-backed security does not suffer even in the event of the creating company becoming bankrupt. So we will learn the creation of asset-backed securities in much more details. Here we are just taking an overview. There is a separate chapter for this, separate reading for this, where we will learn in great details about asset-backed securities. Sources of repayment of proceeds. Repayment means interest and principal. So these are also mentioned in the indenture, how the bond issuer intends to repay, what is the source of these payments. For example, for a sovereign government, it can be the taxes, or it can be the project in which the proceeds from these bonds are invested in. For example, let's say the government is issuing the bond to raise funds for building a bridge, right? This bridge is going to have a toll tax service. They will be collecting toll tax from those who commute. Now, the cash flows that come from this toll tax will be used to make the repayments, that is interest payments and the principal payments. Now, we have to remember that in case of a sovereign national government, the national government provides full faith and credit to these bonds. So if you are buying a sovereign bond, then you are actually betting on the national government, which is the most risk-free entity. Then we take a look at corporate bonds. Now for these bonds, the source can be where the proceeds are invested in. It can be a capex to build a new plant, right? Now there will be production from this plant, right? Now from these production there will be profit, and from these profits there is supposed to be repayment. For asset-backed securities, there are certain underlying financial instruments that we spoke about, right? These instruments can be mortgages, that is real estate mortgages. Once again, these instruments can be mortgages related to real estate. This can be credit card loans or payments. This can be car loans. When the car loans are repaid, these asset-backed security buyers get paid from the proceeds of that. When the credit card holders pay the money back, the asset-backed securities get the money from there. When the home owners repay their installments, the asset-backed securities get their payments from there. That is how the asset-backed securities work. Remember, asset-backed securities means there is always an underlying financial instrument which is earning interest and principal in the form of loan repayments. So now we try to understand what is collateral backing. So whenever a bond is issued, it can either be secured or unsecured. Secured or unsecured. The same entity may have some secured bond issues and the same entity may have some unsecured bond issues. Now what do I mean by secured and unsecured? Secured means there is asset or guarantee backing. This means, let's say a bond of 100 crores is released, and to secure this there is a backing of assets which is 100 crore or more, or some parent entity or some other entity has guaranteed repaying in the case of default by the bond issuer. So this is a secured bond, right? Now we come to what is unsecured bonds. Unsecured bonds means there is no collateral backing. Now, in case of default or in case of repayments, secured bondholders are senior to unsecured bondholders. So we enter a term called seniority. In terms of seniority, secured bondholders are senior to unsecured bondholders. This is because in case of repayments, they will be prioritized, or in case of default, In case of default, they will be paid first, then only the unsecured bonds will be considered. Even in the unsecured bonds, there can be unsecured senior bonds and unsecured subordinated bonds. So, unsecured senior bonds will have more seniority, higher seniority than subordinated bonds. These are also called junior debt. So, while buying, a bondholder has to take care to see whether it is a secured bond they are looking at, whether it is an unsecured bond they are looking at. If they are looking at an unsecured bond, whether it is an unsecured senior bond or a subordinated bond or a junior debt. So, that is very important. Types of collateralization. So, there can be multiple types of collateralization. One is a covered bond. A covered bond means there is not only some asset underlying it. For example, say if the underlying is a financial instrument, say a mortgage, not only the asset or the loan is backing this covered bond. In case of default, there is the bondholders can even reach out to those assets, that is those houses or homes which are funded by these financial mortgages, real assets, right? So, these financial instruments are funding these real assets, and covered bonds not only have recourse to the financial mortgages or the financial instruments. In case of default by these financial instruments, they can take hold of these real assets also. Now, this is a major difference from asset-backed securities. Asset-backed securities can reach out to this, yes, they can reach out to the financial mortgages, but they cannot reach out here. They cannot reach here. They cannot recourse to the real assets. Only the covered bonds can. There can be other examples of collateralization. For example, equipment trust certificates. These can be certificates which are backed by equipments, for example, aircrafts. Now, what happens is the title to this aircraft is held by the trustee, and the trustee leases it to air transportation companies and collects the payments for the lease and repays the bondholders. Companies pay lease, and this lease amount comes to the trustee. The trustee pays back interest to the bondholders. Another example can be collateral trust certificate. Here, the issuer can pledge some stocks. Issuer pledges stocks or bonds, some other bonds basically. They pledge it to the trustee, and the trustee in turn shares it with the bondholders or the bond buyers. So, these are a few examples of collateral backing and their types. Credit enhancement methods. So, credit enhancement is basically reducing the risk of a certain bondholder. So, how do we do that? There are basically two ways of doing it. One is an external credit enhancement, another is an internal credit enhancement. So, let us see what are the different types of external and internal credit enhancement. First, we come to the internal credit enhancements. This can be done through credit tranching. Now, what is credit tranching? Let's say you have a pool of bonds. A corporation has a pool of bonds. Okay. Now, this company divides this bond into different classes, say class A, class B, class C, like that. Okay, this is the bond pool. Now this method is called tranching. Why? Because when the claims will come, the first priority will go to, say, class A bonds. They will have the first claim. Class B bonds will have the second claim. Class C bonds will have the third claim. This means what? Only after A gets paid, if something is left, B will get paid. Otherwise not. Only if A and B both have had their claims satisfied, then only C will be paid. So A has greater seniority than B, B has greater seniority than C. Both A and B therefore have greater seniority than C. Claim hierarchy or seniority. This method is called credit tranching. The second method is called over-collateralization. What does this mean? For example, let's say you are selling ABS, asset-backed securities, and the total pool is 100 million. Now you back it by an asset pool of 150 million. Now this extra 50 million is called over-collateralization. This is called over-collateralization because the value of the underlying instruments of the ABS have been over-collateralized. That is, the collateral required was 100 million, but you have collected an asset pool of 150 million to back these financial instruments. Now we'll look at the third way of an internal credit enhancement. This is called a cash reserve account or an excess spread account. Now an excess spread account is basically the extra amount that is left after paying the bondholders. Extra amount left after repayments. Okay. Now this extra amount can be deposited in a cash reserve account. This will be used to absorb any shortages in cash flows or losses. This will absorb any losses or cash flow shortages. Now we will look at external methods of credit enhancement. So these are internal methods of credit enhancement. Why they are called internal? Because they can be done intrinsically by rearranging the structure of the company's capital situation only. The remaining methods will be focused on using external third parties to protect the credit risk of the bondholders. External credit enhancement is basically using another entity outside the company to provide credit security or reduce the credit risk of the bondholders. So the first way of doing it is providing bank guarantee or providing a surety bond. Providing bank guarantee or providing a surety bond. Now what are these things? Let's say there is a pool of bonds of 100 million. Out of that, a bank decides it will protect the credit risk of the bondholders up till an amount of 75 million. So this amount is called a bank guarantee. On the other hand, let's say there is another pool of $200 million worth of bonds, and an insurer, a regulated and rated insurer, says they will be guaranteeing 150 million out of it. This is a surety bond. So when a bank does it, we call it a bank guarantee. When an insurance company does it, we call it a surety bond, right? And this threshold amount, that is 75 million and 150 million, is basically a threshold or the maximum limit up to which the credit risk is protected. So this is called the penal amount. This is called the penal amount. Above this amount, whatever defaults occur, the bank or the insurance company is not going to protect it. The second method of external credit enhancement is a letter of credit. This is also provided by a financial institution. Let's say the cash flows required to satisfy the bond repayments is $75 million. Okay. These are the repayments at any time. Now, the cash flows are only $50 million currently. So the company is facing a shortfall of 25 million. Right? Now, a financial institution through a letter of credit can protect this again. Now, a financial institution can protect this shortfall by providing a letter of credit to the issuer. This is the cash flow of the issuer. This is the shortfall of the issuer. Now, this LOC, providing this LOC to the issuer, is basically making sure that this shortfall is protected. So the bondholders get what they want to, even if there is a shortfall of cash flows on behalf of the issuer. The third mode, which is basically a layered mode above the above two methods, is basically a cash collateral account. So this is basically, let's say an issuer borrows the repayment amount, and deposits it into a cash collateral account, repayment amount, and deposits it into an account which is called the cash collateral account. This is again provided by an entity. This is an actual deposit, right? So there are cases where this entity might get downgraded, but this cash collateral account, because it is a deposit account, the issuer bonds are not downgraded, protects the bond from downgrades. Now, why we are saying this is a layered protection over and above the letter of credit or the bank guarantee or the surety bond? The reason is, when somebody is buying a bond based on a letter of credit or based on a bank guarantee or based on a surety bond, these all expose the bondholder to third party risk, right? Third party risk means that the insurer will pay, or the bank will pay, or the LOC provider will make up for the shortfall. This kind of a risk is there. If the third party is not able to satisfy, then what? Here in comes the role of the cash collateral account. It is an actual deposit which protects the repayment of the bondholders. Covenants. Covenants are basically instructions on what the issuer should do and should not do on a general basis and also on a given situation, right? So these are legally enforceable instructions. Now, there are two kinds of covenants. One is what they should do, These are called affirmative covenants. Examples of this can be a cross default clause. A cross default clause is basically a recognition of default on defaulting on another debt. Recognition default if the company defaults on some other debt. Let's say a company has released many bonds. One issue has been, let us call it A, another issue let us call it A prime, another issue let us call it A double prime. Now, it did not default on A, it did not default on A prime, but it did default on A double prime. Now, if this clause is there with A bonds, then this bond will also be considered as being defaulted. If it is there with A prime, then this bond will also be considered as defaulted. This is what is meant by cross default clause. The second one is pari passu clause. In English, pari passu means equal footing. So, a bond having a pari passu clause has to be treated as at par, exactly at par with a senior class of bonds. Let's say A is a senior bond and it is declared that A prime is pari passu with A, with respect to A. So that means it will be treated as equally senior with respect to A. A prime is equally senior and has all the same rights, identical rights as A has. Now let us look at the negative covenants, that is what the company should not do, the should nots. There are many examples of this. The first one can be a negative pledge. This is basically prohibition from issue of higher seniority bonds. Let's say A is the highest class of bonds right now in terms of seniority. This can contain a covenant that the company cannot issue A prime, a class of bonds which are senior to A prime. A prime cannot be senior to A at any cost. Any bond issue A prime cannot be senior to A at any cost. This is a negative pledge. Restrictions on debt. There can be prohibitions or limits on new issues, new issue limits or prohibitions. Restrictions on prior claims. This is basically a protection for the uncollateralized bondholders. Let's say the company has a pool of assets. Some of them have been used as collaterals, some of them are free. They are not used as collaterals. Now, suddenly if the issuer wants to use some of these free assets as collaterals, it will not be able to do it if this prior claim restriction is there. They will prevent the free assets from becoming collateralized assets, and in that way it will protect the uncollateralized bond buyers. Restrictions on shareholder distributions. Shareholder distributions means dividends and share buybacks. Now, depending on the profitability, there can be clauses that these things are limited or prohibited. Restrictions from asset disposals. Restrictions on asset disposals. These can be prohibition from creating spin-offs or liquidation of assets. Restrictions on investments. This can be limitation or prohibition on speculative investments. Restrictions on merger and acquisitions. If some merger and acquisition happens, then the new entity may have to follow all the clause and terms that are there in the old bond indentures. must follow, new entity must follow previous indenture. This can be a restriction on merger and acquisition. So these are some of the examples. Care should be taken because too many or too restrictive covenants can actually harm the bondholders more than benefit them. Too harsh covenants can harm the bondholders, because this is because operations of a business is not a straight line event like the payments of a bond, and flexibility is required sometimes to run it in a diligent fashion also. So this has to be kept in mind while looking at the bond covenants. Too many harsh covenants does not necessarily mean that it's going to be good for the bondholders.